Today, we experienced the worst decline since 2020. So it's a good time to act as a doctor and give a diagnosis on this market and on our portfolios and determine what should we do and what is the appropriate treatment and what should we be looking out for. So, worst decline of 2020 or since 2020. What prompts that? Well, it doesn't seem to have been the Fed. There were definitely a lot of people on CNBC today that were talking about the hawkish Fed, but based on what Powell said yesterday. But I actually don't think that was hawkish. I don't think he really said anything new. He said if inflation doesn't go down, we're going to get more tight, and if inflation starts to come down, we're going to be a little easier. I think that is common sense at this point. He said he's pleased with the reaction of financial markets, and I don't think that's a surprise either. We've had the second worst start to the S&P 500 throughout all history. Let's not forget that includes history when online trading didn't occur and trading was less liquid. We're never going to have a 20% down day again, or a 10% down day even. We have circuit breakers now. It's not going to happen, as far as I'm aware. It's my assumption. Didn't happen in the March 2020 collapse, and that was probably the worst crash ever that we'll ever see. I don't see anything getting worse than the entire world completely shutting down for the first time ever. It's pretty hard to beat that. I don't even think nuclear war can beat that. Maybe it can, but who knows? So, it's not the Fed. Bond yields were down today. It's definitely not the Fed. You know what it was? It was Target. Target is down 25% around there at the close. But it's not Target alone that is pulling down the market, because Target isn't big enough to pull down the market 4%. It's the fear around margin compression that is pulling down the market from Target. Target echoed what Walmart said, which was, we misallocated, we didn't understand or predict as strong of a reopening shift in consumer spending, so we didn't buy as many female dresses, for example. We under-anticipated that. CEO took blame. One thing he did say, though, as well, is that there is no sign of consumer slowdown. In my opinion, the only thing that would warrant the biggest sell-off since 2020 would be a big decline in consumer spending. Some clear indicator that the consumer is weakening. That doesn't seem to be the case. Additional evidence that it doesn't seem to be the case is, guess what we also got today? We got TJ Maxx's earnings report. And the stock is up 6% off the highs of the day, but still closing up 6%. That is a discounted clothing retailer, and they didn't put the blame on inflation. They said, yeah, we've got inflationary pressures, but we're going to get through it. We're going to adapt. And the stock's up 6%. I think the Target market takedown is an overreaction, in my opinion. And what are we going to do? There's nothing we can do. We just got to let that be the case. We can't scream at the market. We can't fight the market. You're going to put on the gloves and start fighting the market. It's not going to work. We just have to deal with it and let it happen. Notice that TJ Maxx is basically like almost an identical business to Target. Target has a broader selection of products, but like I said, Target said they misallocated to female dresses. TJ Maxx, much more specific on clothing. Clothing is very much a discretionary item. That stock is up. That stock is saying we're experiencing the same pressures that caused Target to be down, but their stock is up. They're saying they're going to get through it. Target had a bad quarter. No question about that. We were expecting $3 a share EPS. We got $2.19 a share EPS. That EPS miss makes you have to re-rate the stock. And that certainly happened today, down 25%. But the stock has been re-rated. And I don't think diesel pressures are going to last forever. Again, I've been playing energy, still like energy, still expect energy prices to be reasonably high. But I don't expect them to double from here. I don't expect them to go on in perpetuity. I think we're closer to a peak in oil than the trough of negative $37 a barrel. So I have to take that forecast and apply it to Target and say, okay, the stock is re-rated. We're currently closest to the maximum pressure they're going to experience, the maximum shift in where consumers are spending that they're going to experience. And the stock is presenting us with a fantastic opportunity. And guess what? I added that stock because it is a simple, steady stock that happens to be down tremendously, about a quarter to a third of its total valuation. And I personally I think it's actually a good business and can continue to take market share from the dominant player, Walmart. It's being re-rated. You know what also has been re-rated? The stock market overall is down some 20%. We have more stocks down 75 and 90% than we did in March 2020. We're currently almost at the peaks of the 08-09 recession and the dot-com bubble. Almost at those peaks. That is the area of the market that I think is justified to be most concerned about, the excessive froth. Those areas of the market, though, are also down over a year. So we can't, I hear a lot of the bears saying that, oh, we have to drain the excesses. Oh, we have to drain the excesses. A lot of the excesses are drained. Maybe there's a couple drops of liquid left in that, bubble or whatever. But if you're saying we have to drain out the excesses, you should also acknowledge that the excesses have been excessively drained. You should say that, yes, hey, anyone can make any case. The future's uncertain. We don't know what's going to happen. Anyone can make any case. You can say that these stocks need to come down farther. But you should also explain that the near records of stocks down 75 and 90% is not enough. I don't hear anyone mentioning that. It's just kind of like a blanket statement. So I think there are some good value stocks in there. And okay, one other thing. Cisco just reported earnings. Big behemoth type company, very consistent, solid earnings. Lots of companies use it. It's been around since before the dot-com bubble, and it's big. They missed earnings, stocks down 10, 14%. They missed earnings because they're taking a $200 million hit from Russia. I obviously have not read the whole report deeply, but I got the important facts. $200 million hit from Russia. Fourth quarter guidance going from 5.7% growth to down 1 to down 5.5% contraction in that big business. A lot of the big businesses, it seems, are not going to be growing as much as they have in the past. Okay, that might be problematic. It might be problematic. So maybe you want to stay away from a company that is so big and so behemoth-like Cisco. You should be selective. But there's growth occurring in the stock market. There are companies that are growing. They just aren't the companies that are 30 or 40 years old that every single major corporation has the products of already. And they're big. They're complete. They are mature companies. Jumia, for example, grew revenues 50% year on year. 50%. That's a big number. That's not 5.7% growth. That's not 1 to 5.5% growth. That's 50% growth. In that bucket, that's down 75 to 90%. Yes, a couple days ago, it was down more than 90% from the highs. So I think what this means is there's going to be a growth premium assigned to these companies. If you're a company that is growing, we currently have the highest levels of cash on the sidelines by hedge funds since 9/11. There's inflation. I don't think they want cash forever. I don't think they're just going to sit in cash forever. We're at stocks, near record levels of stocks down 75 and 90%. I think a lot of that cash, what's good, Zach? Good to see you on the channel. I think feel free to ask any questions. If you have any questions, drop them below. We'll get to them. I think a lot of that cash on the sidelines is going to chase growth because growth implies that they can take that money and grow it. So record levels of cash, massive drainage, record levels of stocks down 75 and 90%. And the ones that are growing, the ones that are quality, that are down 75 to 90% and are growing, I think if we can be patient, if we can stay relaxed and calm and not worry about what's going to happen tomorrow. Is tomorrow going to be another day like today? I have no idea. I'll tell you in a couple hours. If we can relax, stay calm, look for places to allocate capital and allow that capital to be used, that business to be grown, those products to be sold, etc. I think there are opportunities and tremendous opportunities at that. Jumia was up 30% yesterday. As I said, 50% year-on-year growth from Q1 last year to Q1 this year. Beginning of Q2 this year, they signed a deal with UPS. That's quite massive. UPS is entrusting in Jumia to be its Pan-African partner because Jumia is the largest online retailer in Africa. So let's calm down. Let's not worry so much about the day-to-day. We've pointed out that Target should not have the power to bring the market to the most downside day since 2020. That should be the case. I think this is an overreaction. Do I like utilities for this risk-off environment? If so, which is your favorite? Utilities are not my area of expertise. Here's what I would say to focus on with utilities, though. We're currently experiencing quite a lot of volatility with regards to electricity prices. So there are two types of electricity companies. There are those that have variable contracts with consumers. That means if the price of natural gas, for example, goes up, they can hike their electricity costs. And there are those with fixed contracts that have to deliver electricity at a particular price to consumers. And they just go with the flow of natural gas and they provide it to the consumer at that locked-in price. My assumption is that the ones that have the variable contracts might benefit in a risk-on environment if you're concerned about risk, if you're concerned about downside, because the downside is going to be caused by inflation, by rising energy prices, by overall volatility. So if you're expecting downside, part of that is going to be rising energy prices. You're going to want the companies that can adjust for the increased cost of natural gas. And if you look at Europe is experiencing quite a lot of pain from this. There have been companies with fixed contracts in the UK that have had to close down. Look for variable contract electricity providers. I think those are going to be safe. Do I think they're going to be bullish? I don't know. That's not where I'm allocating capital personally. I'm not really taking a look at that. But what I do know is variable contract sounds better to me right now than fixed contract because we might get what we've seen in the UK. Thank you for the nice comment. I appreciate that. I do appreciate you coming and watching these videos. Feel free to come on anytime to the lives and ask any question. I'll do my best to answer it. So that's today's video. I hope it provided some value. And until next time, peace out.